Are you ready to overcome the complexities and burdens that come with your success? Join the team at Centura Wealth Advisory in the Live Life Liberated podcast. Now, on to the show.
Hello and welcome to Live Life Liberated with the team from Centura Wealth Advisory. Today, we've got Kyle Malmstrom in the hot seat, and he has a guest, a newbie. Matt is with him, but he's not new to Centura. Kyle, why don't you explain who Matt is, what he does, and what you guys are talking about?
Thank you, Eric. How you doing today, by the way?
I'm doing fantastic. What's going on with you?
Oh, doing great. Wonderful day out here. So we got Matt Griffith with us today. He's a senior wealth advisor here at Centura. CFP. He's been with us 4.5 years. He manages clients. He is super technical and a great resource, and clients love him. So I'm happy to have him on here because we got a good conversation to have today about different things that are happening in the world and the planning that we pivoted to since kind of the world's changed over the last year or so.
Sounds
Looking
good.
forward to it, Kyle. Thanks for having me join.
Yeah, super excited to have you on here, Matt. So let's chat. Let's just get right into it, right? So what I want to get to is kind of some of the ideas that we've pivoted to, Matt, with regards to changes in the economic environment, political environment, tax environment, all of those things. But let's set the stage in terms of the things that we think about and that we're monitoring and why we think about them. So let's just get into that. So what's changed in the last 6, 8, 9, 10, 12 months?
Yeah, a lot going on, right? We've had an interest rate environment that's changed dramatically. You know, we're coming off the lows of really 0% interest rates and 500 basis point increase in the last 6 months. Basically, that's a big move there. Kind of a few of the results recently we've seen a little bit of stress in the banking system. Some regional banks taking some hits, some failures, some bank failures. So keeping a pulse on that, along with some potential future tax legislation, just monitoring those things.
Yeah, I would touch upon, SVB, the Silicon Valley Bank, it went down, right? And that was just really a mismatch of short-term liabilities and long-term assets. And they got caught in this interest rate move. And so you got to be cautious on those things. But why'd they move the rates 500 basis points, Matt?
Yeah, I mean, the Fed's moved quickly, right? They're trying to tamp down inflation. We were seeing prints of inflation 8-9% last year. Fortunately, it's started to come down. Most recent prints in the 5% range, still above their mandate. The Fed's got a mandate of a 2% target of inflation. We're still above that, so they're tightening. They want to tighten to slow things down and combat inflation.
Well, it sure feels like inflation if you go to the grocery store or go buy gas or pay your bills, for sure. And then with regards to the economic outlook right here, if you catch any wind of any headline news, it's like, hey, this pending recession's coming.
A lot of talk around that, right? We currently have an inverted yield curve, has been since last July. It's kind of stayed there since last July, and that's been a predictor of prior recessions. And so a lot of economic forecasts are saying, hey, potential recession later this year, maybe first of next year. You can't set your watch by it just because, hey, this inverted yield curve happens, but historically it's been a predictor. Maybe an area to touch in on, with the higher rates and some of the bank struggles, something we're keeping our eye on, commercial lending, right?
Yeah, right now they're predicting there's about a $1 trillion worth of commercial property debt that needs to be restructured, i.e. refinanced before the end of 2025. And what that means is all these people that went out and bought office space or industrial space or retail space, something like that, they're going to have to refinance what they had on a 5-year note or a 7-year note or whatever term they had. They got to refinance that at these higher rates. And that's going to have an impact on that market. And we have some good connections in commercial real estate. And they will tell you, hey, if you're on cash and you're looking to buy real estate, it's probably a pretty good opportunistic standpoint. If you're one of those people that had those low rate and you maxed out your leverage, probably going to be a little rough. But that's going to transpire into kind of some pressure on those small banks and regional banks, which typically made those loans. So there's a little bit of an undetermined future in terms of what's going to happen in the regional bank and the commercial space. So it could add some stress here that we're keeping an eye on.
Yeah, a little setup there, a little context around the economic environment. Let's talk a little bit about the tax environment as well. So post-COVID, right? We had a lot of money being put out there for, I think, the right reasons, but now you could say, hey, we're starting to pay the bill a little bit of that surplus money being put out there in the form of inflation. Now you're starting to see whether it's federal government or even state governments be a little bit revenue starved. And so we start to see some of the talk around raising revenue, which often results in higher tax rates. What are you starting to see on the landscape of either federal government or even state governments?
Yeah, it's a pretty common question and a common conversation we have around here is like, hey, tax rates are headed higher. Matt and I were chatting about this before the podcast, right? You got to have both sides of the aisle kind of agree on it. Right now, the Biden administration put out their proposal. They have various items in there to raise taxes and raise revenue for the government. Where they get it done this year, I don't know. One could argue it might not be till the end of the election year next year, and when they finally get the two houses figured out, or the House and the Senate figured out, and which party controls what, they might get something done then. But the prevailing rate is, hey, we do have $31 trillion and counting right now in debt. California is at a budget deficit of $30 billion, I think, this year, even though they projected like $100 billion surplus last year. That didn't come to fruition. So the entities, the state entities, the state governments, and the federal government need money. And so Biden came out. What did he publish, Matt?
Yeah, let's dig into that a little bit. And yeah, you mentioned the U.S. debt, and unfortunately, we'll probably have to all live through the debt ceiling fight that's impending here coming up. Targeted probably June, July of this year, and we'll have to live through that, of course. But March 6th, 184 pages from the Office of Management and Budget issued. This essentially reflects the president's priorities. Now, keep in mind, this is not law. This is their viewpoint of hey, this is for the fiscal year 23-24 fiscal year, and what they would like to see done. Of course, there has to be proposals from Congress as well that come through, and then they come to an agreement on a budget. But yeah, let's dig in on some of the things that show up either from a corporate standpoint or individual tax standpoint. What did you see there, Kyle?
Sure. First off, they're going to make the corporate tax rate 28 over 21%, the current rate. So for C corporation owners, right, that's 7% right off the bottom line that's going to go to taxes. So that's less money to put back into your business and hire people. So that'll have an impact there. That's probably the first thing. They also talked about raising the marginal tax rate back from 37 to 39.6, and they're going to lower the bracket to $400,000 for single and $450,000 for married filing jointly. I'm going to put a caveat in here. They don't always necessarily have to change the tax rate to change the taxes. They change all the schedules. They change the numbers behind the scenes to increase the taxes. But then on the front, politically speaking, they get to advertise, hey, we didn't change the tax rates. Well, you did, but you just buried it far enough in the tax return. No one, most people aren't going to look at that. So you got to be careful of those details, because those details are what impact you, right? And that's why we have relationships with CPAs and things like that. What else we got, Matt?
Yeah, another one from a capital gains standpoint, they want to raise the capital gains tax rate on incomes greater than $1 million. They want to bump that up to essentially ordinary income rates, 39.6. That's
what's it at now?
Well, it currently starts at 15% for capital gains. It bumps up to 20% once you're over a certain income threshold today.
So it's 100% increase.
Yeah, and this is a repeat. So some of these themes, we saw this in the Build Back Better proposal. Again, didn't get passed. But these are sort of partly why we bring these up. These are recurring themes, right? You just kind of keep seeing these types of increases.
In California, at 39.6, plus if you're making over $1 million to be in that situation, now you're at a 13% California bracket. So now you're at 53%. And then you have net investment income tax, which ties into what we're talking about. Right now, it's 3.8%. So that would have put you at 57%. But guess what? They want to change the net investment income tax from 3.8 to 5%. So now you'd be at 58%. Ouch.
climbing the brackets there, climbing the rate. And again, look, these aren't laws, as this would have to be agreed upon by both U.S. House of Representatives, Senate, and the White House. Likely, like you said, Kyle, not passing anytime soon when you have the split Congress currently. But again, just themes here that we're looking at. What in your opinion, why do we need to keep our pulse on this? Why is this important for us to keep a pulse on it?
And it's all about the bottom dollar, right? I mean, it's about saving as much money from the government as you can. And so the more money you save, the more money you have in your pocket, the more things you can do with it and direct that money to where you want it to go. There's so much change. There's so much nuance. There's so many details to all of this stuff that you got to be full time on it, frankly. And you got to have relationships with people in their disciplines that are full time on it. And you got to talk and you got to meet, and it makes a big impact. For instance, in Washington, they passed an excise tax, which is really a capital gains tax of 7%. Well, in the state of Washington, there is no income tax, state income tax. So now they've employed basically their first income tax, which is a 7% tax on capital gains for anything over $250,000. There's some exclusions for cattle and commercial fishery and small businesses of $10 million of revenue and less. But hey, if you're an executive working at Microsoft and you got large gains in your Microsoft stock and you want to make a big liquidation, oh, guess what? Now there's a 7% tax that you didn't have. And that, their Supreme Court just ruled on that last month.
A big surprise, right? I mean, for those that don't follow all the states, but, Washington, known as a no income tax state. Of course, this, like you said, kind of slid by as an excise tax. But, I think this is an example. Hey, why do we keep our finger on the pulse of, what potential things might be happening out there? It's things like this. All of a sudden you look up and it's like, wow, okay, living in Washington, you're not accustomed to an income tax. Now you've got a gain and potentially subject to a tax there if you're a resident of the state of Washington.
So there's one piece there that I think is noteworthy. So sometimes when states enact new legislation and new taxes like that, there's some bugs in the system, right? And so right now there's a little bit of argument. Hey, how does this work in some fronts? But one of the things that stands out is, hey, there is no capital carry forward loss on the state standpoint with regards to a capital gain. So let's say you had $1 million loss on the federal side, you could carry that forward indefinitely to match against future gains. On the state side, if you have $1 million loss, it doesn't carry forward. And then next year, if you had $1 million gain, they wouldn't offset and you'd pay the 7% on the $1 million gain. Do they fix that? I don't know, probably. But as of right now, the interpretation is that's how it would work. So those are the things, that's a planning opportunity there. Like, hey, if you had a big loss this year, you might want to take some gains because that loss isn't going to match up next year. So you got to be mindful of those things, and you got to be proactive.
Yeah, let's jump into a little bit. So that's the context, right? That's we laid out the economic context, higher interest rates, inflation. You have some potential tax legislation on the horizon. All this is a backdrop. So what does this mean? Let's talk about the profile of a business owner. What are you doing today to help business owners with this both economic and tax backdrop?
Yeah, so we spend a lot of time working with business owners, and I would say, we have pivoted quite a bit on some of the strategies over the last 6 months, just due to all the things we just talked about. One thing that hasn't changed with business owners, and I just want to emphasize it to everybody, is that on the business exit, where there's this big realization of a big liquidity event, which is typically when the most taxes due. Maybe there's a roll-up, but typically there's a big tax due. What I can tell you from having, we have lots of relationships with M&A attorneys, with investment bankers, CPAs. We have all these relationships, and the prevailing, and we ask this question all the time, the prevailing answer is, hey, what percentage of business sales transpire kind of on an unsolicited offer? In other words, hey, business owners not thinking about selling, and they get a random call from XYZ private equity fund or a strategic acquisition from some fund or whatever it is. And, they really weren't thinking about selling. And then, oh, by the way, the offer looks so good. and I've put 20, 25 years of my life in this thing, and this might be my chance. And 50% of the sales that go out there go with a letter of intent, and then they call up their CPA, their M&A attorney, and they're like, hey, I got this offer. I think I'm going to take it. What tax planning can I do? Well, you're a little late to the game in that regard. There's some things you can do, but it is much, much better to do the planning a year in advance. And so even if you're not thinking about selling, I would encourage you to find the relationships to get prepared in case that day comes when you get an unsolicited call. And private equity firms are on the hunt for businesses that generate cash flow. And I know that they have big call centers that'll make outbound calls, 40, 50, 60, 100,000 calls a year just trying to identify businesses. And you may be one of those people, one of the recipient of one of those calls. And next thing you know, you got a letter, which kudos to you. I mean, that's awesome that you're going to get out, but you may wish you had spent a little time up front. So just for what, we call that the gold period. Anytime before that letter of intent, you got all the planning options. Make sure you talk to your professionals ahead of time, even if you're not thinking about it. Like, hey, what do I need to do? Can you coach me up so I can spend some time? Because even if you got the information, it takes months to kind of fix the books and just do the things that you need to do anyway. So you've been working at it for 25 years. Why wouldn't you spend a couple of months getting it dialed in, even if it's a year or two ahead of time? I think you get a much better result. So I just want to throw that out there. From a business standpoint, there's quite a few things we can do if you get ahead of it, Matt, in terms of the tax planning. Like, hey, in California, there's 13% income tax. What are the ways you can mitigate that? Depending on how you think you may structure your sale, there's some opportunities there. We could mitigate the state income tax. You want to know, everyone's situation is going to be pretty unique, and the confluence of factors in your life that result in the optimal situation is going to be specific to you. So what we're talking about here, these ideas are ideas that might apply to you, but it's probably in some combination of everything that's in your life. So just take that for what that's worth. Like, you got to put it all together. The puzzle is specific to you.
How important is it to develop your team of professionals? Certainly we're involved here at Centura in the planning process, but it takes a team, right? Team of professionals. And how important is that?
If you want the best outcome, it takes a team for sure. I think it's super critical. I think it's super important. I can tell you I'm a very resourceful, diligent, some would say cynical type of guy. And I would do my research and I would interview a lot of people so that I know exactly what I'm getting from who, and I'm getting the value. And like, I can appreciate that from all the business owners out there, because you guys are probably all just like that, right? I mean, you're gonna make good decisions, and you're gonna make well-researched decisions. I think you can speed that process up by having people with the right networks, Matt. If you get introduced to the right people, and you get introduced to several of the M&A attorney firms that are big in that space, and you get an opportunity to go interview 3 or 4 of the best, man, your learning curve will go up so fast because you're talking to the right person and they're going to ask you the right questions, and you're going to get to choose from the best ones. And then you're so much farther ahead. In my opinion, if you try to do it on your own, it would take, you may end up finding one right out of the gate you like, but did you get the opportunity to really compare and contrast against other guys? Did you really get the best deal, or are you just settling on, hey, I don't want to spend a lot of time doing this, right?
How about you talked a little bit about what might be a more mature business and going to market and exiting. How about for some of the earlier startup folks that may be considering, or just know, hey, I've got a home run here. I just need to get an entity set up. Is it worth spending some time up front on the entity setup?
Absolutely. I did a podcast with Chuck Levin, I don't know, 5 or 6, 7 podcasts ago. You might want to check that one out.
Episode 70 for those.
You got that one on hand. Nice work, Matt. So look, sometimes you run into people and they just go to LegalZoom. I would highly recommend not doing that. I know it's a cheap version. I know it's a quick version, but then you end up doing a lot of cleanup work afterwards. And it's more expensive. It's harder. And you'll be like, oh, I wish I'd have talked to you beforehand. So let's say, let's talk about somebody that's got a business that they think can really grow. I'm talking about a growth-minded individual, a high performer here that says, hey, this business, I got an idea. It's going to be worth 10, 20, 30, 40 million bucks. If I do this right, it's going to be a big number. Well, that big number is going to be associated with a big tax number. And so you want to get it right. So first thing, like, hey, qualified small business stock. Hey, if you're going to set it up as a C Corp, you'd get $10 million exemption or 10x your basis. So if you started with a C Corp, you owned it 5 years, and then you sold it, you get a $10 million exemption on the sale.
Section 1202, also a prior podcast, episode 67, for those that want to tune into that.
Yeah. And if you're really savvy and you got deep pockets, and business owners that are serial entrepreneurs will do multiple businesses throughout their lifetime. Another way to go about that, if you really think the end goal is $50 to $100 million, would not be to set it up as a C Corp. You could set it up as an LLC, let the revenues grow, get to $5-10 million bucks, and then convert it, pay the tax on that number into a C Corp. And when you do that conversion, now your basis, let's say, is 5 million or 10 million. Your exemption, if you hold it for 5 years on a QSBS standpoint, is 10x that basis. So it could be 50 or 100 million. But you got to be willing to pay the tax. That's kind of the caveat. You got to have some deep pockets there, but there's people that do that. And that's a very sophisticated way to do it. But that takes forethought. That takes planning. In general, you don't accidentally have that happen. You know what I mean?
Yeah. Lot to do for business owners. Let's keep moving down the list here. Executives and hitting, those are maybe high income executives. Actually, I'll jump in real quick just to, again, with this backdrop, changing environment. I mean, we've historically, some of the structures we've talked about on this very podcast in helping executives. One was a charitable lead annuity trust. Obviously the interest rate environment changes. Now we're a higher interest rate environment. There's some question, well, do they still work? It gets more challenging. The break-evens get higher. But again, I think it's situation specific. You might still be able to jump in and using a CLAT to mitigate on the income tax side. There can be some wealth transfer benefits. This is where we get into our planning process and really dive in and say, hey, is this something that could still work? More challenging in a higher rate environment, but potentially something to still look at.
Definitely worth looking at. It's not, to your point, the break even gets a little bit higher, but one, if you're charitably inclined, then it definitely probably makes sense. It probably makes sense if you have a big one-time liquidity event where, you're really pushing up and you're definitely well into those highest brackets and you have a big income number and you need a big deduction for this year, but you give money every year, it could definitely work for you. If you're just aggressive and you say, hey, you know what, I'm in a biotech. I believe in biotech. I believe I'm, in biotech. You're like one day away from a news announcement and your stock quadruples in stock price. If you're one of those people, this could work for you because you got a high growth asset and it would destroy, it would crush the break even because you'd have multiples of growth in one shot. But it's probably a little bit more on, it's got to be geared for the right person. Let's just put it that way. It's totally a situation.
Yeah. And you get into a little bit of that, concentrated wealth, concentrated stock, and just some of the planning, the risk management that goes around that. Like you're saying, if you can build a lot of wealth in that concentration, and that's one side of it, and do very, very well. You have to do some planning around, okay, what is the ultimate exit strategy there? There's a risk management side on the other end of, okay, what if the stock doesn't do that well? And if a lot of your wealth is concentrated there, then, how are you going to potentially mitigate that downside risk?
Yeah, the C-suites that have these big comp plans with stock options and RSUs, a lot of planning to be done. And you're right? Hey, if you want to shoot for the moon and keep that concentration, your play's probably just right for you. If you're a little nervous about this economic situation and you're nervous about all the things we just talked about, and you're like, hey, I want to get out of some of this concentration because I don't really need $100 million. I'm good where I'm at. Then, hey, what are the things that you can do? Well, we work with clients all day long on those ideas. It does get kind of specific to your situation and how you go about it, but there's options there. One thing I do want to talk about, though, as well as like, hey, what if I'm in like, let's face it, on a publicly traded company, on an RSU, you get vested, you could go sell it. You got the ordinary income on the vesting, but you don't pay anything on the gain, and you divest, right? But what if it's not public? What if it's a private company that you got a bunch of RSUs on, and you got a bunch of options, and you got this big concentrated position in this company that's not private, and you don't have a way to get out, right? But you need liquidity for whatever reason. You should talk to us, because there's some programs out there that you can get loans against future IPO. I mean, it's a pretty situational situation, but if it's if they're going to go IPO and there's going to be an exit, there's programs out there that you can get access to liquidity ahead of time to divest from your concentration, maybe create liquidity for another opportunity, whatever it is. There's ways around the non-public side as well.
How about the inverse of the CLAT, or what might be seen as a little bit of an inverse of CLAT, the Charitable Remainder Unit Trust, CRUT? Throwing out lots of acronyms today, but is that maybe more, could be something appealing in this environment?
Seeing a lot more activity in the CRT space for sure, Matt. And one, you can get a good deduction. One, you can get a big lifetime income. The idea behind a CRT is you put an appreciated asset out into a trust, and you sell it. The trust doesn't pay the tax, and then it pays you an income stream, and you pay the gain over a long period of time, kind of like an installment note. But at the end of the day, the money goes to a charity. Pretty useful topic, pretty useful strategy. There's 5 different ways to do it. There's ways to create the income and manage the income. There's some real specific nuance to it where we can coach you through all of that. But super helpful. We're definitely seeing an increase in that strategy.
So we've hit on business owners. We've talked about highly compensated executives. Maybe one third leg here, just again, with that backdrop of higher interest rates, tax legislation, folks that have what would be considered a large estate. In today's federal estate exemption level, $12.9 million per individual. So let's just round off for married couples, your $25 million plus estate. That's where the exemption levels are set today. However, the 2017 Tax Cuts and Jobs Act has that expiring, sunsetting January 1st of 2026. Our best guess is it gets cut in half down to about 6 million each, so a total of 12 million. So you kind of have this range where folks in that, let's call it 10 million plus or 12 million plus dollar estate are okay today, but Jan 1 of 2026 are not, in terms of they would be subject to estate tax at that point, if nothing's changed between now and then. With this higher interest rate environment, what type of planning is available today?
The easy thing is to say, hey, I'm going to wait and see what happens. Right? That's pretty common. Like, well, maybe they don't change it, and maybe it doesn't sunset, or, and to the point that they have only lowered the estate tax exemption one time in history. That being said, Trump made it really, really high. Biden and Bernie Sanders both ran on 3 and 3.5 million. So there's a lot of political pressure to pull it down. I think it's easy for them to let it expire and have it come down. But here's the risk of you not doing the planning, particularly, if your needs are met, right? The Maslow's hierarchy, you got to get your needs met first to make sure you have all your income. But if you're willing to do the estate tax planning, you better do it before the last 6 months of 2025, because everyone's going to be doing it. And you're not going to get evaluation companies. You're not going to get the estate planning attorneys. You're going to have a hard time finding professionals to do it, frankly, or you're going to pay an arm and a leg. So you have an opportunity here now to do it. So with regards to strategies, though, Matt, one of the things that we didn't talk about this at the beginning, but one of the things that's on the that's kind of a reoccurring theme of tax legislative changes would be the elimination of a grantor trust. And a grantor trust is a trust where you get to put assets out into this trust. It grows. The growth of the assets grow outside of your estate, but the tax implications flow back to you. It is a standard in the estate planning arena. I kind of struggle, frankly, to think that they could get rid of it. However, they have brought it up and they put it in several times. I think there could be a run, and people just set those up just so that they have one. So you might consider grantor trusts of some nature. There's discounting. With the increase in rates, discounting becomes a more effective use. So one of the things that comes up is a qualified personal residence trust, and that is a trust that you use your house. It has to be your primary residence. You put it out in this trust. You get to use it for 5, 10, 15 years, and then you get a discount on the value because of the time frame. And the higher the interest rate, the bigger the discount, the more effective that strategy is. That could be something that could work. And then you can combine it with, hey, if you're married filing jointly, you do 2, 1 for each spouse, and then you get 2 discounts and you mitigate the longevity. Like, it's pretty complicated, but it combines with everything, right? I mean, if you're charitably inclined, there's just dozens of strategies out there that can work for you. And it's probably a combination of a couple of them, is my guess.
How do you go about, or I guess, I think this is a place to talk about as a firm, there's all these strategies. How do we get those into, okay, narrow it down to here's a few, or maybe work in conjunction with each other? Maybe talk a little bit about our Liberated Wealth process and just how we do that deep dive. And you've got all these acronyms of these fancy strategies, but
they're fancy. They're very fancy, man. Very fancy strategies. Hey, look, at the beginning of when we meet somebody, we do what we call the uncover phase. And that's a deep dive into everything you got going on, from your family to digging through all the tax returns personally on the corporate side, digging into the estate planning documents, running projections on what the income is going to look like, running projections on what the estate's going to look like, getting a baseline as of to, like, hey, if you didn't do anything, what does it look like? And then you can model it, and then you start to you go from uncover into unlock. And then that's when we start to banter around different ideas based on the facts that we see. And so, hey, someone has a piece of real estate they're going to sell. It's got a bunch of gains in it and a bunch of depreciation. Okay, well, maybe there's a 1031 opportunity there. Oh, hey, I don't want a 1031 because I don't want to manage another piece of rental property. Maybe we find a sponsor for you. Oh, maybe that passive loss goes against there's just so many different combinations of things that can happen. So we just dig in, and then we ask a lot of questions, and we get to know you and say, hey, is this important to you? What, hey, rank these things. What are the sacred cows in your life that you don't want to touch? Are there nostalgic things that, are there emotional? Is there a family member that needs special considerations? Is there a family member that could be litigious? Is there, all these factors kind of come into how you formulate the plan. So we go into this unlock phase where we basically figure out the top 5 or 7 strategies that might work for you. And then we bring them back to you and we say, hey, look, these are the 5 or 7 things. Here's basically how they work. Here's kind of the pros and cons of them. We ranked them this way based on your situation and on monetary savings from a tax perspective or whatever it is. And you're going to say, yeah, let's try to take down, let's really look at 3 of these this year, or 4 of these this year. And then we go into the design phase where we pull in estate planning attorneys and M&A attorneys and international tax attorneys or CPAs, all the specialty people, the valuation people, and we start to design it up so that we can get down to the real numbers and the real design of it.
Some important keys I think you hit upon there. And reflecting back, we talked about the business owner that might get that call out of the blue and decide to, hey, you know what? I like the sound of this. I'm going to exit. I'm going to sell my business. First step of creating that baseline plan, right? That gives them a baseline of saying, okay, here's what this would look like. What is that net dollar amount I'm walking away of doing nothing? I walk away. Is that enough to meet all of my needs, my family's needs? Maybe if I do have some community charitable wishes, whatever it is, starting there, I think that's a key point. And then once you start to layer in some of these strategies, does it help, hinder, hurt the bottom line? That's the idea. And that's, layering those strategies in and should provide a better outcome, but that's just part of the process.
Look, we don't want to take on an engagement if we can't get like 10x. Like, we should be able to create real value. If we're just incrementally saving you like 10, 20 grand, like what's the point, right? I mean, seriously, it's a lot of time and effort to do these things. So we want to make real meaningful differences in people's lives that move the needle. And we're good at assessing whether or not those opportunities exist. And hey, if they don't, which usually they do to some degree, we'll say, hey, look, we'll point you in the right direction. You can do these things. And if not, hey, this is how we're going to work together. Here's what the scope of the engagement would look like. And here's what you can expect. And here's what our deliverables are. And here's our process. And you'll be totally up to speed on how it's all going to work.
So before we wrap this up, let's hit, because we laid the backdrop, economic, tax, and I think we'd be remiss if we didn't touch on the investment solution side today. And, especially the way we led things off with, hey, we've had some banks failing, we've had higher interest rates based on this environment. And, whether it's a business owner exiting, someone that has just an influx of cash, maybe it's an executive that's evaluating their concentrated portfolio and wanting to hedge some of the risk there. Let's talk a little bit about what opportunities we're seeing today. And, again, with this idea that, hey, maybe we're eyeballing a potential recession, whether it happens, whether it doesn't, we don't know exactly. But if I'm in that camp and, hey, I see things slowing down, I see things tightening, where am I going on the investment landscape?
Well, there's two camps. One would be somebody that just had a big inflow of money. Somebody that just got a big inflow of money. Personally, I wouldn't go stick it all in the equity market just because the equity market has some tail risk in it. So what's most important, and that's kind of specific. I don't want to knock anybody out of that, but most importantly is like, hey, coming up with a deployment plan of what you're going to do. How are you going to put money to work? If you got a liquidity event from a business sale, $20, $30 million in cash, you can use a combination of treasuries and private credit and private equity and some equities. And there's lots of different things you can do. But it's like, hey, how do I deploy over a 2, 3, 4, 5 year period where I get different vintages of private real estate and equities, and I kind of dollar cost average into a bigger plan versus like, hey, I got the money and let's just go throw it all in. Like that just seems ripe for issues to me. I mean, if the market turns around and goes, then great, but you got a lot of money. And it's been in a business that you owned and ran your whole time, your whole life, or for some period of time. I just wouldn't necessarily go throw it all in the equity market. I just don't have.
There's a scenario where it works, right? A scenario where, hey, the no recession happens, we get a bounce, and there's a scenario there. But there's some scenarios that where it doesn't, the outcome is not favorable, right? And hey, markets continue to be volatile. You have a major equity portfolio, and we have some short-term volatility, we'll call it, and that's a bumpy ride.
Well, yeah, and let's face it, you take somebody that's a business owner who's had all their money in their business and probably had a 401k and had pretty minimal stock and equity exposure in their life relative to their net worth. And then if you had that big liquidity event and you put it in the market and the market drops 40%, you're not going to be real happy. It's not even just, I don't care how many conversations we have about volatility. I don't think you're going to be happy. I don't even want to have that conversation with you, which is why I wouldn't do it. Because markets get kind of goofy at the wrong time. Look, does it change your life if you miss out on the next 20% run in the equity markets? If it does, well, that's a little bit different, but I'm going to wager to bet that it doesn't. What probably does impact your life is if you lose 20 or 30% in the equity markets, that probably changes your life. So it's just conversations about what's really important to you, right? It's framing what's important to you.
Our philosophy is we want to provide superior risk-adjusted after-tax returns. And the good news in today's environment, we can move lower on the risk spectrum and actually receive some yield. Starting just with, we talked earlier, of treasuries or really short-term interest rates moving up, you get more out of treasuries than what we have in the last probably 10 years of a zero interest rate environment. So that's a starting point, but then you kind of move along the spectrum even further, and in some cases getting up double digit type of yield in certain, when you get on the private alternative side and I'd frame it as, hey, it's a great time to be a lender, because now those lenders and private credit, and you can see some real yield there. So again, it has to be addressed from a portfolio standpoint, but I think there's that whole backdrop, and the reason we want to talk about it is, hey, this has changed a lot from just 6 months ago.
It has. Man, I think we're running out of time here. We got a pretty long podcast. I agree with, hey, there's lots of options out there on the investment front. To be honest with you, on the treasury side, just last thing, it's been kind of nice being able to use treasuries as a short-term parking spot. We haven't been able to do that in a long, long time. So 5%, people are pretty happy with that on a deployment plan. Look, if your situation, we hit upon a lot of things here. And if any of these situations sound like you, we're here to help, and we're happy to help. And we will spend some time with you and analyze your situation and have real conversations about what's important to you, and come back with some ideas and say, hey, does this fit the bill? That's what's important. And then it's the plans are going to change over time, and there's always dynamics. And I think having the right team in place is important for those types of people.
Yeah, I think that's a good summary. And look, to close it out here, for those that lasted this long, Kyle, your and my Super Bowl champion Kansas City Chiefs made their first draft pick last night. So we'll do a little projection here. Felix Anadike Uzoma out of Kansas State is an edge rusher. In this next year, plus or minus 5 sacks on the year.
Oh, you changed it on me. You had 6 earlier.
I started at 6. It was too high, though.
Probably under 5, only because he'll be a rookie. But
all right, that's a prediction. We're going to hold you to it.
Go Chiefs.
It's recorded. We have that proof. So later on, we can take a look. Yeah, gentlemen, this has been fantastic. Speaking of conversations that you guys need to have, it's any listening member of the audience who has lasted this long, it's a great podcast. They need to be able to reach out to have this conversation. What contact information should they use?
You can find us on CenturaWealth.com, or you can email Matt Griffith at CenturaWealth.com, or our phone number, 858-771-9500.
That's
9500.
That's M, first initial M Griffith at CenturaWealth.com.
What did I say?
You said Matt Griffith.
Oh, it is M Griffith.
M Griffith. Yep. Sounds good. Gentlemen, now they have that contact information. I encourage every audience member to reach out to also give their prediction of what's going on in this next NFL year. Should be some interesting emails coming in, guys. So again, thank you so much for your time today. Thank you for the education. And our last thank you always goes to the listening audience. Thank you so much for tuning in and listening to the Live Life Liberated podcast with the team from Centura Wealth Advisory. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when the team comes out with a new podcast, it'll show up directly on your listening device. And we humbly ask that you share this podcast, rate it, and leave a review, as this actually does help others find the show. Again, thank you so much for listening today. For everyone at Centura Wealth Advisory, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Live Life Liberated podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Centura Wealth Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Centura Wealth Advisory. Centura is an SEC registered investment advisor with its principal place of business in San Diego, California. Centura and its representatives are in compliance with the current registration and notice filing requirements imposed on SEC registered investment advisors, in which Centura maintains clients. Centura may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same results.